Well, we want to introduce our next market guest. We have Scott Kimball, co-head of fixed income for BMO Global Asset Management, and Francis Newton-Stacy, Optimal Capital Director of Strategy. And Scott and Francis, we'll get to you both in just one moment. First, I do want to highlight some of the market action in these final moments of the regular trading day. Now, stocks are in the green across the board. The Nasdaq is the big outperformer this afternoon, up about 1.4%. The S&P 500 following closely behind with a gain of about 1% as well, and the Dow up by about 190 points or 0.6%. Now, today has been all about those tech stocks. We've been talking about the growth share rebound, the rebound in cryptocurrencies and Bitcoin as well. Want to give a check of those prices, up about 20% now after a plunge that we saw over this past week, extending into this weekend. But again, taking a look at the sector action here, we do have the communication services, information technology, and the real estate sectors, the big outperformers today. Utilities, the only sector that is in the red. And then taking a look at some of the action in the Dow, we have Microsoft, Cisco, and Intel all outperforming. Here's the closing bell on the New York Stock Exchange.
All right, we're going to put a fork in it for Monday, and we're going to see where these markets settle. We're going to be in the green when they finally drop the gavel, and we'll let you know what the final numbers are going to be. Let's take a look. We expect the Dow to be up roughly 185 points when it settles. The S&P 500 up about 41 points, and the Nasdaq up about 190 points. Some of the winners on the Dow today, as you heard Emily just alluding to, you had Microsoft up almost a little bit more than 2.25%. Salesforce, Cisco, Intel, they were all up more than 1.5%. Some of the losers on the Dow today, Amgen, Home Depot, and United Health, they were all off. Let's go back to our guest and talk about what we're witnessing here. And Francis, I want to bring you in because you've been talking about what's been going on with volatility and the inflation narrative, quote, still winning the day. And yet you look at the 10-year and it just can't break through the resistance, which I think is 1.69. If inflation is winning, why aren't we breaking through 1.69 on the 10-year?
Well, we've been in the inflation trade since November, and that's the thing is, markets are always going to front run those prints, and then we just have to figure out when we're going to rotate into the next regime. We know that growth and inflation are going to decelerate coming into the back half of the year because instead of coming off the worst numbers in history, we're going to be coming off the best numbers in history. So we're looking for early signs of that rotation, but it's not happening yet. As far as the 10-year, of course, 50% retracement on the day off the low, but you're right, it is not breaking out. Gold is showing some relative strength, watching 175 on the GLD. U.S. dollars still breaking down. That's a good inflationary trend that's still in place, of course, trading inverse to the commodities. Also watching volatility breaking down here. The outperformance in the NASDAQ today is the 10-year, and just also its relative weakness means relative cheapness as long as the VXN keeps breaking down. So early indicators of a rotation are going to be changes in trend along those fronts.
Scott, I want to turn it over to you. Should investors be concerned about potential reactions to this week's personal consumption expenditures report, or have some of these inflation fears for April already been priced in after the CPI and PPI reports we just got?
A fair amount of the inflation upsides or the inflation surprise story has certainly been baked into the markets for a bit. But I think as Francis had said, we were coming off of a very low base out of COVID, where the economy really had nowhere to go but up. So we knew with certainty that there would be some reflation trade, particularly as it relates to consumer consumption. But as we approach more full, not going to say full employment because we're still a clip away from that, but as we move towards more full employment, or we should say more specifically recovered employment, we should start to see some slack or a little bit of resistance in the actual consumption data itself as more people have moved back to their office perhaps, or more people are starting to get back out to about their lives and more economic reopening. So the number itself is important, but we do anticipate there's going to be some resistance to the further gains you could see in some of this data, again, going into, looking ahead to the Q3 and Q4 data.
As we do look ahead, Scott, we're going to get data tomorrow. I think it's Case-Shiller S&P home price for March. Now, I don't think anybody expects that to fall. But have we hit the ceiling there, especially as people go back and this zeal for I need to have more space, perhaps people don't need it? Might we start to see that cool off and bring down the companies like Home Depot that are tied to that? Might they start to fall as well?
So housing is one where we have a reminder that's being set, which is that if we look back to the last time we had a major disruption or reallocation of capital in the housing markets, which would be the financial crisis, what we saw is that there is a huge amount of regional effects that show up. So for instance, I'm in Florida, where we've gained anywhere between 250,000 to 400,000 new residents in the last year. And we're starting to see that has certainly transmitted through into the housing prices, but also the input prices for construction in the southeastern United States. As you look across the further across other parts of the country, their own sub-economies that take place in states are having different factors weigh on them. What we think in our position on housing continues to be the regional effects are going to remain in force. But ultimately, it's too soon for us to say that there's going to be a shift in the way consumer behaviors are evolving as it relates to housing. What we've seen going back through multiple housing cycles is that tends to have a bit of a long lag. There's a significant amount of elasticity that shows up in broad housing data, and it takes a while for those preferences to change once consumers start saving, spending, and more importantly, borrowing towards achieving a change in their housing choices.
And Francis, you in your note brought up the topic of commodity price increases. Of course, with oil especially, we have been seeing that move to the upside and extending a rebound that we saw over the past several months now. What are your expectations there, and when should we expect to see some moderation? Are we going to have to wait until after the summer when that travel season is over?
Well, it's going to be interesting. Of course, this has everything to do with the Middle Eastern news. So this could be volatile going through the summer. But I think that the expected demand is either going to be what it's expected to be, or outdo what we thought the expected demand is going to be, because people are going to be out and about, and they've got savings and they're willing to spend. And as we see the reopening fully manifest and people are taking their masks off and very excited to get back to normal, I still see the inverse to the dollar trade happening. I think the dollar is going to break down into the 88.28 range, breaking through its low from February 25th at 89.60 something. And so that's going to support commodity prices. And again, a reversal in the dollar that's meaningful is going to indicate a change or a rotation into a different kind of, maybe we rotate into stagflation because growth decelerates first, or maybe we rotate into, where we have inflation pulling off first. I think growth is going to pull off first, but we'll have to wait and see. Toward the end of the year, we may have some problems in credit markets depending on how these mortgages shake out. Janet Yellen testified that 10% were not paying their mortgages, 20% were not paying their rents. Let's see how that hits credit market data toward the end of the year. We could have a little swoop down into the deflationary realm if we've got bad credit data coming off of those best numbers, and then we have that deceleration.
Well, when I hear you say stagflation, Francis, I think to my childhood in the 1970s. Real quick, how does an investor listening to what you just said then, because you're watching gold, play gold? It seems to me that would be the defensive play right now, and you better hurry up.
Well, it's interesting because gold is sort of the outlier when you look at what worked during COVID, right? The dollar's down, duration is down, and yet gold is just kind of sort of taken off. So yes, obviously investors are sort of thinking about something. And the other thing that's interesting is people talk about Bitcoin as being the new gold. We obviously don't have intrinsic value or any kind of meaningful historical data on Bitcoin. So what we can really look at is the correlations. And Bitcoin is not correlated to gold. So I think if we have a stagflationary play, or which gold does well in, or if we have a deflationary play, I see Bitcoin selling off and people going into Old Faithful gold, and looking for the GLD to hold 175 here to see if the upward momentum in the recent weeks is sustainable.
Well, we will certainly see if that does prove to be sustainable. But thank you so much, Scott Kimball, co-head of fixed income for BMO Global Asset Management, and Francis Newton Stacy, Optimal Capital Director of Strategy.